A Singapore-based budget airline, Jetstar Asia, will cease operations from July 31st due to increasing costs and competition. It'll continue to operate flights for the next 7 weeks and gradually reduce its schedule. Affected customers will be contacted with the option for a full cash refund or an alternative flight wherever possible. 17 flights are affected in total, of which 16 are intra-Asia. The airline started operations back in December 2004. Its stakeholders are Qantas Group and Westbrook Investments. This announcement does not impact Jetstar Airways or Jetstar Japan. Authorities in Singapore are working closely with the over 500 affected employees. Singapore Manual and Mercantile Workers Union says it has worked closely with Jetstar Asia and negotiated with the company to ensure that affected members and workers are treated with care and will receive fair compensation. Jetstar Asia has committed to providing a comprehensive retrenchment package. For more insights, we're now joined by Subhas Menon, who is Director General of the Association of Asia Pacific Airlines. Subhas, good to have you on the show. Now, Jetstar Asia has struggled to turn a profit for most years now closing because it says costs in Singapore have jumped and competition is fierce. In your view, what does this say about running a low-cost carrier out of a high-cost hub like Changi Airport?
Well, I think it is less a commentary on aviation and low-cost operations in Singapore than, on the strategy of Qantas Group, for the future. So, it made sense probably 21 years ago for Jetstar Asia to be set up here when the cost base in Singapore was probably lower than the cost base in Australia, But as you and I know, the costs in Singapore have risen over the years, and that being the case, maybe the cost base now is probably at the same level as in Australia, or maybe even higher. So Qantas is probably making a decision to spend its capital investment in more lucrative ventures, like upgrading its premium service and cashing in on the thriving full service market.
So does this high-profile exit then signal that other Asia-Pacific low-cost carriers need to rethink their business models or cost structures? What warning signs should managers and investors be looking out for then?
Not really. I think, there are enough low-cost operations to Singapore. And I think it is more, how big an operation you have here, because low-cost carriers operate on the basis of volume, So it is more or less, if you are not able to, get the economies of scale in an operation, then you might as well put your investment in other markets, And in this case, Qantas is actually investing in its own home base, and has made a decision that the full service, premium service is probably more lucrative for them.
Right, so back to your earlier point that we've seen airlines like Scoot, AirAsia and others ramping up capacity after the pandemic. So you think that Jetstar Asia's challenges were unique to them, so we're not seeing a broader squeeze on intra-Asian budget airlines in general?
Yeah, I don't think it is anything to do with budget operations. We have quite a few budget carriers operating in Singapore. From what I read about Qantas's statement, it is more a strategic decision, and Qantas has been investing a lot of time and effort in Australia itself to grow its premium service.
But Changi Airport's higher airport fees and even moving Jetstar Asia to Terminal 4, now those were mentioned as pain points. How big a deal do you think these airport-related costs and logistics are when it comes to low-cost carriers? Their margins are already thin.
It's not that any particular cost that is weighing down on the operations, but I think it is the unit cost, and you have to look at the comparative unit cost of where you're going to put your capacity. And if it doesn't make sense in one hub, then you have to focus on other hubs, other home bases, because Jetstar was operating out of Singapore like a Singaporean carrier, so it makes more sense for them to invest in their own home base in Australia.
Okay. So as you mentioned, Qantas redeploying Jetstar's A320s back to Australia and New Zealand for domestic growth. So what lessons are there for parent groups deciding on where to invest capital during these uncertain times?
Well, I think when you're talking about hub operations, you have to have a big presence, especially if you're running a low-cost carrier. And if you're unable to do that, then you're better off in investing that capital to other markets where you can make it work and you can achieve economies of scale.
And up to 500 roles in Singapore will be affected, though there's talk of support as well as redeployment. From your experience, will this be handled equitably?
I think so. I think Singapore is very efficient, and the Qantas Group is also very efficient. So I think between them, they will find a good way of managing this exit.
Final question, looking beyond this case, do you see a future where budget carriers in higher cost regions might consolidate or merge more often?
Well, I think budget carriers, from what we have seen, especially in the Asia-Pacific region, have been focusing on, expanding into different hubs, looking for cheaper unit costs, cost basis to operate from, they basically stick to their knitting. And they focus entirely on low-cost operations, So I think in the next few years, I mean, it's a dynamic environment. The next few years, I think we will see budget carriers sticking to their guns and full-service carriers also, focusing a lot more on full-service operations, which, it is good to see that, since the borders reopen, both the leisure as well as the premium segments in the region have been growing very well. In 2024, the leisure segment grew some 21%. The business segment or the premium segment grew by 17 or 18%. So they are both doing very well. And that augurs well for the Singapore hub as well.
Subhas, appreciate all those insights. That was Subhas Menon, Director General of the Association of Asia Pacific Airlines.